What is diversification? Diversification serves as a vital risk mitigating strategy widely implemented across various risk management practices. It aims to distribute potential risks across multiple variables, thereby balancing movements within a group. This discussion focuses on diversification in the context of investment portfolios. Selecting investable assets is crucial, but the overall returns generated by a portfolio are equally dependent on effective risk management strategies. As one of the key techniques in portfolio optimization, diversification embodies the principle of not putting all your eggs in one basket. While a diversified portfolio is generally advantageous, over-diversification can lead to adverse effects. Investors should be cautious and not acquire new positions merely for the sake of diversification, as this can introduce unintended risks rather than serving as a safeguard against losses. Although diversification is beneficial, excessive diversification can be counterproductive. Reducing volatility is a primary goal of diversification. Investors continually adjust their portfolios in response to changing market conditions and information flow, striving to mitigate risk and enhance returns. Effective risk management enables investors to adopt a broader perspective on their portfolios, prompting them to include new positions based on contingency plans for significant holdings. Diversification primarily aims to prevent the risk of substantial losses resulting from adverse investment decisions. Portfolio diversification can be categorized into several types. One of the most common methods involves diversification across asset classes, allowing investors to hold a mix of equities, bonds, exchange-traded funds, ETFs, and derivatives, each with varying risk profiles. Conservative investors often allocate substantial portions of their portfolios to fixed-income securities, while others may seek ETFs to balance volatility by gaining exposure to AB. Another form of diversification occurs through industry classification. The performance of industries can vary significantly during different phases of the business cycle. For example, during economic expansion, investors might favor industries such as financial services, consumer discretionary, and technology, while defensive sectors like telecommunications and healthcare may be preferred during recessions. By diversifying across industries, investors aim to capitalize on prevailing trends within broader economic cycles. In a globalized economy, overseas investments also represent a crucial aspect of diversification. Engaging with various international markets allows investors to hedge against currency and political risks. Exposure to successful global companies, such as Hyundai and Samsung, provides unique opportunities for portfolio growth. While diversification offers numerous benefits, it also has its drawbacks. The complexity of managing a diversified portfolio can be daunting for novice investors, particularly regarding the myriad securities and dynamic allocations. Although diversification can limit both potential gains and losses, over the short term, it may appear less profitable than expected. Additionally, the increased frequency of trading and repositioning associated with a diversified portfolio often results in higher brokerage costs. Despite these challenges, the long-term advantages of diversification in reducing overall portfolio risk make it an essential strategy for investors.